Domestic equity markets underwent a roller coaster ride last week after panic-triggered sell-off in Adani Group stocks capped gains, despite Gautam Adani's step to prepay some loans backed by pledged shares. Since the Hindenburg report emerged, the brutal rout wiped out more than half the market value of all 10 Adani Group stocks. That said, some respite was brought to the market as investors cheered economic surveys' 6 to 6.8% growth projection for 2023-24 with 6.5% baseline expectation. The Union Budget 2023-24 too tamed bears as it announced higher capex outlay and reject tax slabs under the new tax regime. Globally, the US Federal Reserve's dovish stance invigorated investor sentiment as rates were hiked by 25 basis points, taking fund rates between 4.5 to 4.7%. Against this backdrop, benchmark indices Nifty 50 and the S&P BSE Sensex gained up to 2.5% last week. This week, charts suggest a negative bias for the NSE Nifty, while the S&P BSE Sensex is likely to remain range-bound.
The NSE Nifty is seen exhibiting a negative bias on the weekly chart. On the downside, the 50 WMA at 17,260 and the 200 DMA at 17,290 are the crucial supports. Currently, the Nifty has pulled back after coming within striking distance of these supports. However, the Nifty is likely to find strength only on sustained trade above 17,950, that is the 100-day daily moving average. Similarly, the Sensex needs to top the 60,850 level for fresh strength to emerge. On the upside, the BSE benchmark can potentially rally towards its record high above the 63,000 mark. This week, the Sensex may guide it in the range of 59,200 to 61,800.
Meanwhile, the Reserve Bank of India will hold its 3-day MPC meet from February 6 to February 8. After the panel raised interest rates by 225 basis points since April 2022, analysts expect the central bank to raise rates by 25 basis points in this meeting. Moreover, they expect the committee to pause rate hikes after the February meeting in order to let growth breathe. Pranjul Bhandari, chief economist for India and Indonesia at HSBC, for instance, also expects the RBI to hike rates by 25 basis points this week. We expect the RBI to hike rates by 25 basis points in the upcoming policy meeting, taking the repo rate to 6.5%, says Bhandari. With growth slowing, we expect no future rate hikes, although risks remain. And because core inflation will likely remain elevated, we expect no rate cuts either in FY24, she says.
Post the US Fed meeting where US Fed increased interest rates by 25 basis points, we believe that RBI should also increase rates this week by 25 basis points, post which there could be a pause by RBI. Amongst sectors which should do well this week, we believe that banking is one space which should do well, where asset quality issues are behind them and growth has started picking up, while there is still room for margin expansion. Apart from that, auto OEMs, especially passenger vehicle and commercial vehicle manufacturers, should also do well because there is improved visibility in terms of earnings growth. And the third sector which should do well is industrials and capital goods, especially because of government's focus on investments, which can also be clearly seen from the focus which the government has given in this year's budget. We believe these are the three sectors which should do well this week.
That said, global cues, Q3 earnings, fund flow action, and Adani Group stock movement will sway market mood. Companies like Adani Transmission, Tata Steel, JK Paper, Muthoot Finance, among others, will report Q3 FY23 earnings today.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.